Let's talk about life insurance. What is it? At a base level, life insurance is money, but it's money delivered at a specific time because of a specific event. The money is predetermined when you buy a life insurance policy, and the event is the death of the life insurer. So as part of a financial plan, people take a look at how much life insurance do I need. So this first video, we're going to talk about how do you determine how much life insurance you need, and then the sister video is going to be how does life insurance work. So there's two ways that you can figure out the amount of life insurance you need. The first is what's known as capital needs analysis. So for a number of years, I taught at the Kinlan School of Business at Fanshawe College, and one of the courses I taught was insurance planning. So this is right out of the textbook, but it's also out of 3 decades of experience of being a licensed life insurance professional. So the first one is figuring out how much money is needed at death, the capital needs analysis. So the first decision is how much debt do I have? See, I have a professional opinion that the debts you create while you're alive should expire when you die. So typically for Canadians, there are debts like a mortgage, a car loan, credit cards, and student debt. Those are the major debts. So the first part of the process is really quite easy. It's listing down these various things and writing out how much do I owe. Then the second is looking after future expenses, particularly if you have children. So often the case, if you have children, people have what's known as an RESP, Registered Education Savings Plan. It's setting money aside so that they can help their children with the cost of post-secondary education. Well, if you die when your children are 2 or 3, you're not going to be around to fund that. And so typically, what people do is they put a lump sum aside for each child. Then, I don't know what your children's are like, but mine played travel hockey, mine went to summer camp, mine needed the latest shoes and clothing, and so there were costs associated with getting my kids to 18 years of age. Now the reality is some people, when I do this exercise, it's year 21, because kids tend to be staying at home a little bit longer. And so the second thing you do is figure out how much you spend on each child and multiply it by the number of years they have left until they hit age 18. And then finally, if you have a spouse. If you were a 2-income family, yes, the mortgage is gone. Yes, the kids are being looked after. But a lot of your retirement savings and their lifestyle was driven from 2 incomes. And so the last part is, how much of my income do I want replaced to my spouse for how long? We get a number for that. We have those 3 numbers, we add them up. That's the total capital that's needed if you pass. Then what we need to do is subtract the life insurance you already own. If you work for a large company, you probably have 2 or 3 times your base salary in life insurance. You may have bought some life insurance when you've got your first house. You subtract that and you have a difference. That gives you a number. The second way that people come up with a number is called an economic life value. What is economic life value? Let's say you take a 35-year-old engineer and he's married with 2 children. He works for an engineering firm and the future is rosy. He's moving up. And he goes out on Friday night with his friends, and as he's crossing the road, he gets hit by a drunk driver and killed. The widow is going to say, "Oh my God, I'm suing you for wrongful death." He had a huge economic career ahead of him. He was going to be taking pay raises, being made partner, getting ownership in the company. He was in the pension plan. We had health plan. I've lost all that. And so what the lawyers do is they do a present value of all income that's going to be earned. And then they come up with a number. Now, the interesting thing is, if you were 61, the number would be very small because you have a little bit of economic life left. Not value to your life left, but economic life left. If you're 29 and you've just become a doctor, you have a long economic life ahead of you. The 2 ways, capital needs and economic life value. Sort of when you go through all the math, in the first one, the numbers come out to somewhere between 8 times and 11 times your annual salary. And in economic life value, depending on some of the assumptions, it's anywhere from about 9 times to 15 times your annual salary. My experience in over 3 decades, people that have a really good risk management program, 10 times their annual salary. So you can just do the math in your head right now. How much life insurance do you need? We'll talk about the different types of life insurance in our next video. Talk to you soon.